Okay, let's just be honest here. We usually spend our time looking at trends, trying to see what might happen in, 6 months or a year.
Right, the forecasting game.
Exactly. But today, we are not predicting anything. We are living through it right now. It is Sunday, January 25th, 2026.
Mhm.
And if you haven't looked at the markets in the last 48 hours, you might want to find a chair.
It's definitely one of those weekends where you keep refreshing the data feed because you assume the app must be glitching.
I thought my screen was broken. I mean, we are talking about numbers that sound like they're from a sci-fi novel about hyperinflation.
They really do.
Silver has officially broken the psychological barrier of $100 an ounce. And gold is knocking on the door of 5,000.
It's staggering. And just to put that in perspective for everyone, back in 1980, silver hit a record of about $50.
50, yeah.
It took 45 years, 4.5 decades, just to
Yeah.
break that record. And now, well, seemingly in the blink of an eye, we haven't just broken it, we've doubled it.
That is the part that blows my mind, the velocity. But, okay, that's our mission for this deep dive. We're not just here to gawk at the price tag.
Although it is hard not to.
It is. We need to unpack why this is happening right now. Is this just inflation? Is it geopolitical panic? Or is there something, happening in the plumbing of the global markets from Shanghai to New York that we're missing?
It's a mix of all of that. But there are some real surprises in the data. What's fascinating is that while the price is screaming higher, the market behavior is actually, well, let's call it fractured.
Fractured. How so?
You have gold ETFs buying hand over fist, but silver ETFs are actually selling. Plus, there's this massive misunderstanding spreading online about what's happening in China.
And I know we're going to get to the conspiracy corner later because I have questions about market manipulation versus spoofing. I need to know if the game is rigged.
We will definitely get there.
But let's start with that vertical move. Just how fast did this all happen?
It went parabolic. I mean, silver started the week below $90. By Friday, it had crossed 100, hitting a high of, $101.22.
That's a 5% move in one day.
In a single session for a major global commodity. And you have to remember, in 2025, the metal more than doubled in value. Now we're up another 25% just in the first few weeks of 2026.
So if I'm an investor, I'm thrilled. But if I'm just a regular person trying to buy groceries, I'm getting a little nervous. When gold and silver do this, it usually means something is wrong somewhere else. Is this the safe haven trade? Is the world just scared?
Absolutely. The world is highly anxious. If you look at the headlines we're seeing this month, it's a perfect storm for anxiety.
What?
We have a significant rift opening up in U.S.-Europe relations. There are tensions involving NATO and Greenland, of all places.
Okay, hold on. Greenland. I feel like I missed a chapter there. Why is this standoff in the Arctic driving gold prices in New York?
Well, it's not just about the ice. It's about strategic control of resources. Greenland is sitting on massive deposits of rare earth minerals.
Crucial for tech and defense.
Crucial. So when you see friction there involving NATO, it signals to the market that the struggle for resources and strategic shipping lanes is escalating to a military level.
And that scares money.
That scares money out of paper assets and into real assets faster than almost anything else.
So it's a fight over the raw materials of the future. That makes sense.
Precisely. And on top of that, you have reports circulating about armadas moving toward Iran.
Yeah.
Combine that with the economic anxiety, the fear that the stock market is also at record highs, but looking very shaky. People run for the exits.
And the exit in this case is hard assets.
It's hard assets.
Right, because if the stock market crashes, you want something you can hold. But what about interest rates? Usually high rates are bad for gold and silver because they don't pay you anything.
That's the conventional wisdom, yeah.
Yeah.
But we have a Federal Reserve meeting coming up on January 27th and 28th. The market expects rates to stay put for now. But there is a strong anticipation of cuts later in 2026. And the market is always forward-looking. It's pricing in a world where holding cash becomes less attractive and holding metal becomes, well, essential.
Okay, so the macro picture is scary, and that drives prices up. That tracks. But you mentioned something earlier I want to drill down into. You called the market fractured.
Right.
Gold and silver investors are doing opposite things.
This is one of the most interesting anomalies right now. If you look at gold, ETF investment, that's exchange-traded funds, is surging.
These are the people who want exposure but don't want the actual bars in their house.
Exactly. Short-term investors, institutions, they're buying because they fear a stock market crash. They want safety, and they want it fast.
Okay, so they're clicking buy on gold for protection. Simple enough.
Precisely. But silver,
Yeah.
paradoxically, silver ETF investors are selling.
Wait, what?
In the first 2 weeks of January 2026 alone, they sold something like 15 million ounces.
That makes no sense. Why would you sell when the price is rocketing to the moon? $100 silver is the dream scenario.
It is, and that's exactly why they're selling. It's pure profit-taking. Silver investors tend to be a bit more speculative than, say, gold bugs. They saw the price hit 100, a number they've been dreaming of for decades, and they're cashing out.
So they hit their target and they're gone.
But here's where it gets really messy. The physical reality of the market is completely disconnected from that paper market.
How so?
The refineries are backed up, completely clogged. Because the price is so high, regular people are selling their old silver scrap, jewelry, statues, silverware, everything.
Everyone's cleaning out grandma's attic to make a quick buck.
Exactly. But the demand from investors is for 1,000-ounce commercial bars. So the refiners are so busy trying to melt down all this scrap and recast it that some of them are actually refusing to buy any more old scrap.
They can't process it fast enough.
They cannot.
So let me get this straight. The price is at an all-time high, but if I walk into a refinery with a bag of silver spoons, they might slam the door in my face.
Essentially, yes. They're drowning in metal. It's the ultimate bottleneck, starving for commercial bars, but choking on grandma's silverware.
Wow. It's a tug of war between profit-taking and panic buying.
That's it.
Okay, speaking of panic, let's go overseas. I keep seeing headlines and tweets, saying China is running out of silver. People post charts showing the Shanghai price is way higher than New York. Is that real?
This is one of those internet rumors that needs a serious fact check. We call it the Shanghai premium myth.
Yes, okay.
Yes. If you look at the raw number, silver trades higher in Shanghai. Let's say it's trading at the equivalent of $110 while New York is at 100.
Right, so it looks like a shortage. It looks like they're willing to pay a massive premium to get their hands on it.
But you have to account for the tax. China has a 13% value-added tax, a VAT.
Okay, walk me through the math on that.
Sure. If the price is $110, but 13% of that is tax that goes to the government, the sellers isn't actually getting that full amount. When you strip out that tax to compare apples to apples with New York, the actual price of the metal in Shanghai is significantly lower.
So it's actually cheaper in China once you take out the tax.
It's trading at a discount. And that discount tells us there is no shortage. In fact, supply is backing up there. The issue is the government has been slow to issue export licenses.
So the metal is stuck there.
It's stuck. It's increasing local supply and keeping the local price relative to the world lower. So no, China's not running out of silver.
Okay, myth busted. But you also mentioned India. Is the story different there?
Completely different. India is where the real story is. Traditionally, India acts as the world's shock absorber for silver.
How does that work?
Indian buyers are very price sensitive. When silver prices spike, Indians usually sell. They use silver as a store of value, almost like a quasi-currency. They cash in when it gets expensive.
So usually when the price goes up, India floods the market with recycled silver, which cools the price down.
Exactly. They provide the liquidity that balances the market, but not this time. And that is a huge shift in behavior.
What are they doing now?
Currently, Indian holders are not selling. They're hoarding. They expect even higher prices.
So the shock absorber is broken?
The release valve is welded shut. This means the usual flow of recycled silver from India back into the global market is just dried up.
And that's sucking liquidity out of the market.
Think of it like a black hole for silver. It goes into India and it doesn't come out. That ripples all the way through London to New York.
That is a crucial distinction. The Chinese shortage is a myth, but the Indian hoarding is very, very real.
It changes the supply dynamic completely. If India doesn't sell, the global market gets much tighter, much faster.
Let's switch gears to the industrial side. We talk a lot about investment, but silver is used in, electronics, solar panels. Is that still a major driver at $100 an ounce?
They can't stop. We're in the 5th consecutive year of a structural deficit in silver, largely driven by the solar panel industry. Even at these prices, industrial demand is sticky.
And there are those fears of U.S. tariffs on imports.
Exactly, which is causing companies to stockpile whatever they can get their hands on.
But there's another metal story brewing here, too. It's not just gold and silver. Platinum and palladium are waking up.
They are. Platinum is up over 4% recently. And this connects to a fascinating pivot in the auto industry.
The electric vehicle revolution.
Or rather, the reevaluation of it. A few years ago, the consensus was that battery electric vehicles, pure EVs, would take over the world by 2030.
Right.
But consumers are pushing back. They're shifting to hybrids.
I've noticed that. A lot more hybrids on the road. Range anxiety is a real thing.
And here's why that matters for metals. A pure battery EV uses no platinum group metals. None. But a hybrid. A hybrid has an internal combustion engine, which means it needs a catalytic converter.
To scrub emissions?
Right. And that means it uses more platinum and palladium than even a conventional car.
So the green revolution slowing down is actually bullish for these metals.
Exactly. This shift back toward hybrids is driving platinum prices up. You have supply disruptions in mining, plus this unexpected demand surge from hybrids. It caught the market completely off guard.
Because everyone just assumed the combustion engine was dead?
They priced it as if it were dead. And it's clearly not.
That is such a great example of how you can't just look at one trend in isolation. Okay, I promised we'd go here, so we have to. The C word, conspiracy.
Here we go.
Listen, every time silver prices move or don't move, people scream, manipulation.
Yep.
And usually the finger points at the big banks, specifically JP Morgan.
Mm-hmm.
And the listener question we got is a valid one. How can you say there's no manipulation when JP Morgan paid nearly $1 billion in fines? That happened. It's a fact.
It is a fact. But we have to be very precise about what they were fined for. There is a massive difference between spoofing and suppression.
Okay, unpack that for us, because from the outside, it all looks like cheating.
Spoofing is a short-term game. A trader places a massive fake order, say, to sell a huge amount of silver with no intention of ever executing it.
It's like faking a punch to make someone flinch.
It's exactly that. They fake the punch, the market flinches and drops, they buy what they need at a lower price, and then they cancel the fake order. It's illegal, it's unethical, but it is short-term.
Minutes or hours.
Right. Suppression, on the other hand, is the conspiracy theory that there's a decades-long coordinated effort by banks to keep the price of silver artificially low forever.
To protect the fiat currency system, that's the argument.
That's the argument. But the fine, the billion-dollar fine, was for failing to supervise its employees.
So it was rogue traders?
Essentially, yes. They had traders who were spoofing the market to make quick bonuses, and the bank let it happen. It wasn't a corporate strategy to kill the price of silver. It was negligence.
Negligence, not a grand master plan.
Right. And history gives us a great parallel here. The famous orange juice case with Drexel Burnham Lambert in the 80s.
The orange juice case? You mean like the movie Trading Places?
Almost exactly like that.
Yeah.
The frozen, concentrated orange juice market. A trader accused Drexel of naked shorting, of trying to suppress the price.
Okay.
When the investigators went in, they found Drexel was running a hedged book.
Hedged book. That sounds like banker jargon. What does it mean?
It means matched trades. If they were short, they had a corresponding long position or physical inventory. It was actually conservative banking, risk management, not manipulation.
I see.
The same applies today. There are 504 million ounces of open interest on the COMEX right now. People see the huge short side and think they're trying to crash it.
But mostly those shorts are banks hedging their physical inventories.
Exactly. You don't insure your house because you want it to burn down. You insure it to protect your asset. Banks shorting futures against their physical holdings is the same thing.
Okay, that clears it up. The distinction between faking a punch and holding the whole market down is important. But let's look forward. We're at $100, $5,000 for gold. The charts look like a rocket ship. What happens when the fuel runs out?
Well, gravity is a law of nature, and it applies to markets, too. We have to be clear. Markets that go vertical, what we call parabolic, often correct ugly.
Ugly how? Like a slow decline or a cliff edge?
Fast and violent. You have to understand the volatility. Back when silver was $5 an ounce, a volatile day was a 50-cent swing.
Okay.
At $100 an ounce, a volatile day is a $7.50 swing. We are going to see extreme daily variance. If you're leveraged, you could be wiped out in an afternoon.
So don't bet the farm just because the line is going up.
Please don't. But, and this is the important but, even with the risk of a short-term crash, the long-term view has shifted. An analyst pointed out that the investment demand curve shifted upward about 25 years ago, and it hasn't stopped. It means people want hard assets more than they used to, and that desire isn't going away. So even if silver crashes tomorrow from 100 down to 70...
That feels like a crash.
It does. But the average price for the year will likely be much higher than last year's average, which was around $40. Even a crash to 70 keeps the upward trend intact.
So don't obsess over the spot price today. Look at the annual average. That calms the nerves a bit.
Exactly. I remain bullish long-term, not because I love the metal, but because I hold a fairly pessimistic view of the world's economic and political stability.
As long as there's instability, the floor for these prices keeps rising.
That's the insurance policy. And right now, business is booming.
Well, we certainly have enough chaos to go around. So let's tie this all together. We are in uncharted territory. $100 silver, $5,000 gold. It's driven by genuine geopolitical fear, Greenland, Iran. It's driven by a rethink of green energy with hybrids boosting platinum. And it's happening even though ETF investors are taking profits.
And despite the fact that China isn't actually short on silver, the key takeaway for me is India. Watch India. If they keep hoarding, this rally has legs.
It really is a fascinating puzzle. And here's where I want to leave you, the listener, today. We spend so much time looking at the price of gold and silver going up. We say, wow, silver's expensive.
Great.
But I want you to flip the telescope around. In a world of persistent 5% inflation, shifting global alliances, and currency debasement, ask yourself this. Is the metal actually getting more expensive? Or is the money in your pocket just becoming worth that much less?
That is the ultimate question.
Yeah.
It's all about relative value.
Something to think about as you watch the ticker this week. Stay curious, stay skeptical, and please watch out for the gravity in these markets. Thanks for diving in with us.
Take care.